New Year is kicking off with a bang. We have a lot of volatility in the stock market, and the US dollar has been flying. Well, we want to know more about all of this, and we're going to bring in Jim Welsh with Macro Tides to talk about, you know, everything that's happening. I mean, hey, Jim, how are you? Happy Friday, Happy New Year.
All of the above. Thank you very much. With a new year, you want to come up with some kind of a slogan. So jumping and jiving in 25.
Yeah, I
Uh,
mean, 2025 has got to be a great year of volatility. We got an incoming president-elect for a second term who's going to bring in a lot of mayhem, I think. And
yep.
I mean, to kick it off, we saw some aggressive stock market selling yesterday. Today, it's coming all back, and I'm assuming it's, as we head into the inauguration, it's going to, stocks are recovering because of that. But we had this dollar that made this nasty, nasty blast higher yesterday, to kick off the year.
Yep.
What are you making of all this? Because I know the title of today's show is about the dollar, and we're going to get into the charts. But what do you make of these moves?
Well, they were expected, at least so far. I mean, as we've been talking the last couple of weeks, Blake, I've been showing different charts in terms of it nearing an important high. I think in the last 2 weeks, I had a chart comparing the dollar's performance in the last few months overlaid 2017, which also was obviously President Trump taking office. The dollar topped and subsequently had a pretty good decline. Positioning, sentiment have been extremely bullish. But the last piece, and we talked about this last week, was the dollar's price pattern suggested we could have one more pop above the prior high at 108.54, which is what you saw yesterday. Big move. And I think that is going to represent a very significant high for the dollar. And as we've talked, I think over the next 12 to 18 months, the dollar will decline below 95.
I mean,
So,
I hear your call, and I know it's a big call, but we should probably just jump into some of your charts so you have some
yeah.
fodder for this statement, because a lot of people are expecting some really big things from President Trump, and a lot of it is supposed to be very dollar positive. So let's get into the charts here, and
Yeah.
you tell us what we're looking at first.
Well, the one thing I have to address, the assumption that everything that Donald Trump is going to do is bullish the dollar. The one important thing that people are overlooking is in 2017, his philosophy was, in theory, a strong dollar sounds good, but in practice, not so good. So here's a guy who really wants to use the dollar as a tool to increase exports. Well, the only way you do that is to have a lower dollar. This is Bank of America comes up with a fair value, and what percent above fair value is the dollar currently? Well, it's the most since 1985. You can see in 2002, the dollar peaked at about 121, and then by 2008, it was at 70. But at that point in time, it was a little bit over 15% above fair value. In 2000, January 2017, it was about 15% overvalued. In 2020, when the dollar peaked, again, 15%. Well, currently, it's about 22%. So it is, relative to history, it in prior peaks, the dollar is very overvalued. And again, I think it's a reflection, Blake, of people believing that Donald Trump and policies is going to be positive for the dollar, which could prove ironic if indeed at some point in time in the next handful of months, he or Treasury Secretary Bessent, talk about, well, a weaker dollar, something casting aspersion on the faith that markets have that Donald Trump believes in a stronger dollar.
Well, one of the things that's been very supportive of the dollar is the data. I mean,
Hmm.
let's not forget, like you look at today's data, we had ISM manufacturing data come in better than expected. The employment, component was a little weaker, but the headline number was better than
Yeah,
expected, still contractionary. But
yeah,
this is I call it a Trump bump today in our community. I was like, hey, we're getting, it's the manufacturing, and people feel that manufacturing is going to be storing back. I'd be surprised if we had a weaker number. No, the data was a little bit better than expected.
yeah,
So tell us a
yeah.
little bit about, the data that we're getting.
Yeah, well, this is interesting. This is the Economic Surprise Index. And what we can see is it's in purple or blue, depending on how your eyes are working this morning. And what we can see is since mid-December, it's been trending down. And so most of the data points that have been coming in, Blake, have been coming in under estimates. That doesn't make them weak in the absolute sense. All right. Again, the way this thing is calculated is the data comes in and they compare it to what were the estimates. And when the estimates are higher than the current data point, even if the data point was a plus, the economic surprise index declines. And I'm showing this, and we've shown this numerous times over the last 6 months or so, is there's a pretty good correlation between the economic surprise index and the trend in the 10-year yield. So the point here is yes, the ISM number may cause the surprise index to tick up a little bit, but it's been in a pretty pronounced decline. And the gap between where the surprise index and where the 10-year yield has been is pretty wide. So to me, this is supportive of the idea that we'll see the surprise or the 10-year yield come down. The one thing I'll point out, behavior changes based on perceptions of what's coming. So there's a perception that tariffs are going to be raised. We don't know how much. Is it 5%? Is it 25%? But what's happening, Blake, is companies and people are buying stuff in anticipation that at some point in time in the future, the price of what they're paying for is going to go up. And so we're getting, if you will, demand being pulled forward as people and companies choose to say, you know what? I'm beating the clock. I'm getting in under the gun. I'm going to buy some stuff, put it in inventory because I think prices will be higher 3, 6 months from now. And so I think that's helping the economy in the fourth quarter and will help it probably early 2025. But the point is, when you pull demand forward, it creates kind of a dip out there in the future. Instead
Sure.
of there being a straight line, you're going to see people pull back. Hey, I've got enough of what I want. And the other component here, Blake, the Federal Reserve and Chair Powell talked about it, the level of uncertainty regarding what's going to happen with tariffs, what's going to happen with deportations is exceedingly high. And if we think about it, if you're a CEO of a company, you're optimistic, regarding a President Trump, some of his policies, pro-growth, and so forth. But until things actually start to happen and take shape, you're going to be inclined to say, well, let's wait and see how this plays out for a little bit. So I think there's going to be a natural tendency for a lot of people to kind of sit on their hands for a little bit before they commit. And obviously that creates an environment where, the economy slows a touch. And then lastly, the Fed's cut the funds rate 100 basis points. The 10-year yield went up 100 basis points. Mortgage rates are tied to the 10-year yield, not the Fed funds rate. So housing, I can see, unless we see a meaningful decline in the 10-year yield, housing is going to remain. It won't be a net contributor to GDP next year.
Yeah.
So this is an important chart, and it's something that I monitor just about daily, the economic surprise index, because again, there's the correlation between it and the 10-year yield has been pretty good.
All right. Well, one of the things that it would, as a driver of, well, I say as a driver of the dollar is 10-year yield as well.
Mhm.
And you've been looking for the dollar to peak at some point. And so here's the dollar index. Tell us what you're seeing here.
Well, again, as we've been talking, from the low that we saw a few months ago, in September, I think it was, 1, 2, 3, 4, and then wave five has kind of broken out into a 1, 2, 3, 4, 5 all by itself. And that's why the last couple of weeks, I'm like, I think you could see one more pop like above that 108.54 high that we saw about a week and a half or so ago. We got it. And so to me, this is a top. And as long as the dollar does not close, let's say about 110, then I think that, that's kind of, that would cause me to say, okay, let me reassess here a little bit. But the positioning, sentiment, all these things are coming into play. Now what we need to do is see a reversal. As you can see, the 5 and 13 moving exponential moving averages are still positive. So the trend is up. This is just a price pattern that implies we're near a high, and now we have to see if in fact we see some weakness. My guess would be it probably we'll see some choppiness, I think, between now and the inauguration.
Well, and don't forget, I mean, next week we have the jobs report, and everybody's going to be closely watching the jobs report as well, right?
Yep, absolutely.
All right.
Absolutely.
Okay. Well, then you think the dollar top is in. What about gold?
Well, irony here is again, I think wave three from the low in September of 22 topped back in October. And so we're in wave four. I think it's not complete. Wave two from that September 22 low took about 4 months. So we take 4 months from October, that kind of says February, March would be where they would be relatively equivalent in time. So my expectation is, and has been, we're going to see gold drop below 25.41 and potentially, a price target of A and C being equal is 24.75. A 382 retracement of the rally, the wave three rally, gets you down to about 24.15. Sentiment is still pretty bullish. Positioning hasn't scaled back. One of the reasons I thought we were set up for a correction back in October, Blake, was that the long in gold futures had reached a level that had coincided with other significant corrections going back the last 3 4 years. So what's happened is, despite this pullback and choppiness, the positioning hasn't scaled back yet. And that's why I think gold is going to drop below 25.41. And that flush should, generate more, balanced approach to gold and diminish some of the bullish sentiment.
And it's not common, or it hasn't been in my career anyway, for the last 25 years of trading, to see gold and the dollar really move in the same direction. But they have been for the last several months. So I guess to see them continue to move in tandem, if you think the dollar is going to go down
Yeah.
and gold too, I mean, it's possible.
Yeah, no, it's happened in the past. So, I mean, more often than not, my view, and I think what you just said, is that they move in opposite direction. And that happens a lot. But I'm just looking at the price pattern here and sentiment and positioning and kind of saying, you know what? I think they got to take out 25.41 to get that, the cleansing of a correction to get the people who are bullish to become a little bit less bullish. And
Okay.
but bigger picture, once wave four is over, I think we're going to see gold go to a higher high.
All right. Well, the next chart you brought is the S&P. So the S&P is, I mean, it tested some pretty key levels this week. You can see it
Yeah,
right over here, very, very near-term level. And
yeah.
by the way, just, so for people's reference, from this level right here to this level right here, this was a 618 retracement right here. So it looks like pretty key support. Do you think we're going to actually break down ahead of the inauguration, or is there going to be some stock market buying like we're seeing today,
Yeah.
ahead of a Trump, coming into office?
Getting above like 59.45, which was the high we've seen in the last week, would imply that we're going to see some additional upside. At the same time, bullishness is really high in the market, just like gold. And there's a part of me that believes that in order to get a real tradable low, you need to take out that red trend line and get a little bit of a quick flush. The two legs being equal, getting down towards, I thought we'd get it below last week. I think we're getting below 58.32. Well, we did yesterday. We got the 58.29. All right. And so that opens the door, like as you're saying, hold support, get a pop. I do think we're going to break below. The probability favors breaking that 58.30 convincingly, get below, ideally below 5800, and then we'll have a trading low that I think be worth playing. The one thing I will note is if the S&P manages to go to a new high, the advanced decline line, Blake, it'd be very difficult for the advanced decline line to confirm a marginal new high in the S&P. And that is one of the classic signals of an important top, whether it precedes a 10 to 15% correction or a bear market type correction. So that's what happened in January of 22. The S&P made a new high. The 80 line didn't get above where it had been in November of 21, and obviously reasons to sell showed up. So I'm in the mind like, okay, I think there's more downside coming. It's just a question of how the pieces are going to fall in place. I would prefer a quick drop and then a rally to a higher high. Um, but right now, to me, I still think the odds are we're making an important top, or in the process of making an important top.
Okay. All right. Well, the next chart you brought is TLT, and I know you wanted to talk about Bitcoin, and I thought you brought a chart, but I just realized you did not. So,
Oh,
but
I'm
there
sorry.
we can.
I forgot
It's
to
okay.
send
We
that
can
to you,
talk
buddy.
about it. Just we won't
Yeah,
have some charts to
one
go
chart to
over it.
look at. Okay.
Yeah. But
So,
here's TLT.
yeah, okay. So the bearish count is very straightforward. We're going to see treasury yields just keep climbing. In other words, the economy's not slowing. Inflation is going to pick up. People are going to be, continuing to worry significantly about the deficit, and treasury yields are going above where they were in October of last year. If that happens, I think the market would be vulnerable to a pretty good sized correction. The alternative is that the bond market is completing a correction that started in December of last year, and that equates to TLT getting to that 100.57, the green capital A. So my belief has been that the low we saw in October of 23, that rally was wave A. What we've been doing since then is A down, B up to 101.54, and now we're near the end of a wave C that will complete the green wave B. That'll be followed by a C wave rally that takes TLT above 101 54 or 64, whatever. I can't read the number.
Yeah, it's
So
somewhere up here.
up there, exactly. So that's the bullish pattern, but I'm, acknowledging and have been acknowledged that, the selling pressure has been pretty intense, and so forth, that TLT and treasury yields need to kind of hold right about where they are at this point in time. You can see the last 8 or 9 trading days, we're just going in a very, very tight range.
Yeah, we've been
So
basing, right? Just
yes.
basing right
Well,
now.
you could see in that kind of a pattern after the kind of decline, could you see a spike down, on potentially a piece of news like the jobs report and then a reversal? That would be, to me, encouraging at this point in time. So, I'm basically neutral. It's oversold. You can see the RSI at the bottom panel. It's been kind of popping and holding right near 30. So it's oversold. If you look, back in October of last year, it got down to 30. Oh, we had a huge rally. April of this year got down to 30. A very choppy, but it turned out to be a fairly significant rally. We got a bounce off of the lows in October. So again, we're oversold. So to me, being short here makes no sense. But we need to see momentum start to shift to the upside. And I'm from Missouri. It's got to prove something to me now.
All right. Well, Jim, you also you like I said, we had a chart for Bitcoin, or at least you thought you were going to have
I
one.
prepared it, but I didn't
But
send it.
you know what I can do is I'll pull up Bitcoin, but I want to let you do a little bit of talking as I get the chart prepared.
Yeah. So I think that Bitcoin has completed 5 waves up from the low it made at just over 15,000. And that implies even if one is bullish, there's going to be a fairly decent retracement. And the 382 retracement from 15,000 and change up to the 108,000 and change comes in around 72,000. Also, Bitcoin, head and shoulders are kind of a funny pattern because you look at it, oh my God, look at that could be a head and shoulders. And until it breaks the neckline, it means nothing. The neckline in terms of Bitcoin is around 91,000. So it went from 108 and change to 91,000. And therefore, if you take out that 91,000, 17,000 from the 108 to 91 gets you down to around 74,000. So to me, the five up implies a 382 retracements around 72,000. A close below 91 projects down towards 74,000. There were bounces up to about 103, 300. So, kind of been in a little box here the last handful of weeks. The bearish count would, I don't want to say be negated, but it's certainly been weakened if Bitcoin gets above 103, 300.
Okay. And what you're trying to point out here is this 91,000 is pretty critical support. And if that breaks,
Yeah.
you would have, I mean, it's not going to be pretty looking, but you would have basically a head and shoulder pattern type of.
Yeah, and time-wise, it could hold up for a little bit. Again, people are looking forward to President Trump being inaugurated and so forth.
Sure.
Again, we have bullish sentiment that is really, really high in a lot of markets and negative sentiment in treasuries. So, I just think there's going to be retracement, a retracement in the bullish sentiment in those markets and a retracement at a minimum in the bearish market in terms of treasury yields.
And I mean, if we were to complete this, it would take Bitcoin down to 72, 73,000, which would be I would argue a very, very important level of support.
Yeah. I mean, again, let's not forget Bitcoin over the years. I think there's been a couple corrections that were in excess of 80%. So we're talking about a 30% decline. Well, that's pretty moderate based on the history of Bitcoin.
Sure. Well, Jim, I'm looking forward to 2025 with you. I know there's going to be so many moving parts, and it's going to be just an amazing market to trade. What's the best way people can thank you for having a great 2024 and looking towards 2025?
Become a subscriber, and you'll get some key information, some trading ideas, and I think a better understanding of how do we put the fundamental aspects of the economy, monetary policy, integrated with technical analysis, which is kind of what we try to do every Friday.
Well, make sure that you guys reach out to Jim. You can jump in the comments down below to add to something that maybe you were thinking, or maybe if you have any questions for him, or you can email him at jimwelshmacro@gmail.com. Is that correct?
Yeah, or macrotides.com.
All right. Well, Jim, I want to say Happy New Year to you and your family, and
thank you so much.
I'm really looking forward to rocking it out with you this year.
Me too. I think this is going to be a really exciting. It's going to be challenging, but it's going to be a very exciting year.
All right. Well, we're looking forward to it. So thank you so much, Jim. Happy New Year to you, and we'll catch you next week.
You got it, Blake. Thanks.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.